All right, what a finish. What a finish to the day, because we actually had a really good finish to just the actual trading day. But what an outstanding week we've had. What a great month that we have for the month of March. And of course, a great quarter, especially for the NASDAQ 100, 100, the Qs. What a great move. So we got a lot of really good bullish patterns today. So I'm going to break down those patterns to see just how bullish we now are, right? Are we, we are really kind of beginning stages of what could be a really good intermediate rally to the upside. And considering all the factors that are out there that people tweet about in terms of how bullish we've been this first few months, a lot of these factors lining up some pretty high odds of us getting back to 4,800 really relatively quickly by the end of the year. So, I mean, it would take a really kind of a significant undertaking to not do that now, considering all those factors that are lining up. So I'm going to break down the signals that may be pushing us in that direction, as well as some of the signals that we're missing, and what does that mean, and how significant are those missing signals to the start of this move, and why was the NASDAQ so bullish this quarter relative to its peers. So we're going to break all that down in today's video, take a look at the sector moves, take a look at the different asset classes, especially in bonds. Bonds has a very fascinating pattern developing, and that's going to be very significant as to our future expectations, whether or not we can actually hit that 4,800 mark. So we're going to break all that down in our trade idea of a stock that's also kind of showing the same pattern as the broader market. We'll talk about how to trade that. So let's go ahead and get started. Today is Friday, March the 31st, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. As always, if you're watching our video on our blog, check out some of these things over here on the right, including our Market Outlook live video. Come down to the bottom, click this heart. Look at that, 126. That's one of the bigger numbers I've seen in a long time. Thank you all very much for the likes there. Click on that, it opens up this tab, hit that like button. Same thing here, click the thumbs up icon, opens up a new tab, hit that like button. Again, the more you do that, it really helps us out. It gets our content out to all of our followers. Make sure you always get our content. The more you interact with us, that's why we always ask for it. So thank you, everyone who liked the video and does that day by day, day after day. For those who don't, you can do it right now while you're watching with one or two really easy clicks here. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we really followed through on that bear tag to the upside. So I mentioned on that day that if we can get in the next day or two a continuation of this move and get more than 2.5% above the 30-day moving average, then that's about as good as you can get. And that is about as good as we can get. I mean, that's a really good finish to the week. It's a very strong week. You can see the intermediate lines crossed above 50. So that's why you got the dark green shading. The moving average now is rising because we're so far above it. That's about as bullish, the beginning of a bullish move as we've seen. Very good move there. We'll take a look at some other indicators, but just by itself, this looks really good on the S&P 500. Let's take a look at the NASDAQ 100, which has been the most bullish. It got the dark green shading green line a long time ago, but now it really broke out here. The intermediate lines well into the reversal zone. The near-term lines also followed the momentum line up to extremely high levels. The momentum line is down. Market sentiment's rising well in the bullish territory. So very bullish on the NASDAQ. If you look at the S&P, we didn't look at the near-term line. So again, a little bit of a red flag is the fact that the near-term line's up so high and the momentum line didn't even get above the 62nd percentile, much less anywhere near the upper reversal zone. So the fact that it's so extreme and the momentum line didn't precede it's a little bit of a concern there. It kind of goes to show, again, the small ranges that we've been getting on this move is why we can't get the momentum line to get up there. Let's look at the Dow Jones Industrial Average. You see a very same thing, right? Near-term line really breaking out. We're only 2% above. It hasn't been as bullish, so it was a good day today. The near-term momentum line rising finally. Again, the intermediate line at least crossing above market sentiment, and its market sentiment is rising finally in that bearish levels. So it is looking relatively, you don't have the dark green shading the green line yet, but you're close, right? The Russell 2000 looks very similar. We don't have a yellow line yet because we're not above. We don't have the bear tag. We're not above the moving average. We're still 1% below it. The intermediate line still in bearish territory and rising. The market sentiment is still falling. So this is the weakest one by far. The near-term line did get up there. It's already coming back down. So the Russell hasn't been as bullish, and that's obviously been the case. It's a good day today, but again, it's not. We've seen lots of moves on the near-term line from bearish levels fail. And so this would not be the first time that this kind of move failed here. So this is not what we want to see, but at least we see it on the beginnings of it on SPX, right? This, is despite the fact that the near-term line is not quite, is a little bit of a red flag. Despite that, that's about as good of a chart as you'd like to see. Getting the bear tag, extending beyond the bear tag, and getting above the 2.5% mark within a day or two. I mean, again, that's about what all these other bear tags look like when we started bearish runs. So really, really good chart. Let's take a look at the weekly chart. And you can see the near-term line rising back up again off of these levels, off of bullish low point. Obviously, we're not past this high point yet, but again, dark green shading in the green line again on the weekly version. So that's a good sign. We're well more than 2.5% above the moving average. So we're good from that perspective. So on the daily and the weekly chart, you are just starting some potentially long-term moves to the upside, according to these patterns. Really, really good-looking charts here. The NASDAQ, of course, has already been showing this because of how bullish it is. We are above those highs on the NASDAQ. We got a strong near-term line on the weekly chart, mind you, on the NASDAQ. Intermediate line way up there, and market sentiment at low levels starting to move up. I mean, look how high we are on the, how high above the 30-day moving average. We're higher above the 30-day moving average than we've been since way over here, since February of 2021. Like, from that point, we were never this high. We've got a few peaks, but this is a pretty good level. Like here we were 11.17%. Here we were 11.38, and over here we were at 11.5. Now we're 12. So, I mean, that's really good for the NASDAQ. Of course, the Russell, on the other hand, dark pink shading in a red line still. Like, the near-term line's rising, but it's not in bullish levels, and the intermediate line's still falling. And so it's, again, it's kind of it still remains to be a tale of two stories. And that story is, if you follow me on Twitter, that story is a very divergent move between the NASDAQ and everything else, really. But especially the Dow Jones. We've had 2 consecutive quarters of the S&P closing 7% or higher. This is the first time that we've had such a bullish move in the S&P, fueled by a 20% gain in the NASDAQ, that the Dow did not join the party. The Dow just was flat. At best, it was flat. It avoided being negative because of the late rally in the last half of the day today, brought the month-to-date or the quarter-to-date return to the Dow positive. So it was flat, whereas the NASDAQ was up 20%. So it's a very significant divergence after last quarter, the fourth quarter of last year, where the Dow was up 15+%, and the NASDAQ was literally flat, like it was up less than 1%. So for a quarter, so you've seen how we've shifted from the Dow being the big driver of that 7% move in the S&P to the NASDAQ being the big and only driver of the 7% move in the S&P. So we've just shifted from one area of the market to another area of the market, which is not typically something you see at the beginning of bull markets because everything goes up. This is the only time, like I said, this is the only time that the NASDAQ has rallied more than 19.5%, and the Dow didn't rally too. Right? The average of all the other times where the NASDAQ has rallied 19.5% over a quarter is a 13.5% rally for the Dow. And again, we were flat. We were barely positive only because of a late half-day rally today. So this is not normal for the beginnings of bullish trends to have the NASDAQ have one single niche area. That's actually pretty darn normal for the end of bullish markets, not the beginnings of them when everything goes up at the same time. At the end, then we start to rotate from one overvalued area to a different area that can then be overvalued. That's not as overvalued. and we just kind of take turns trying to keep the breath going, right, in that bull market before it finally ends. So here's the Dow, dark green shading the green line, not so bad, on the weekly chart, mind you. So let's go to the Russell, which is the other, half, and again, I think we've already seen this, haven't we? The dark pink shading and the red line there. All right, it's also the end of a month. So let's take a look at the monthly chart for the S&P 500. So here's the month, and you think, okay, a bull tag. We actually finished above the moving average. We had been below it, so we actually got a bull tag all the way up until the last half day of trading today. And that late rally pushed us up to avoid a bull tag on here. And you can see we still got all these other bull tags that we haven't cleared to the upside. Now that can change. You can see if you follow my cursor to the right, that can change, right? We can clear that in this next month in April. April is the best month from what I've seen, if I remember correctly, from what I've seen on Twitter. April's seasonally the best month for the market, if not, one of those last quarter months. So this can definitely change. We can clear that candle, because once you clear that candle with a bull tag, you do take off to the upside. So we are quite there. We are pretty close to being there. Your NASDAQ, which has been so bullish, does not look so good, right? In fact, it kind of has a little bit of a bull tag too, and hasn't cleared that level, that bull tag either. And you'd think that it's a lot more bullish, but the reason why is we were down here, we were 17.25% below the 30-month moving average at the end of December. The S&P 500, to give you some perspective, was actually had been above the 30-month in November. It was only down 4.85% below down here, 4.85% below the 30-month moving average. Again, the NASDAQ was 17.25% below. So the main reason why the NASDAQ did so well, because it was so bearish throughout most of 2022, that it basically just had a little bit of a catch-up. The near-term line got up here. It's not in the upper reversal zone yet. That can change. But as of right now, that's not necessarily the most bullish pattern. And we haven't cleared that bull tag yet. The Dow Jones Industrial Average kind of has, right? So we did get above it there at the end of last year. Remember, the Dow was so bullish in the fourth quarter. That's what drove the S&P gains. So it kind of did clear that, only to then come back down, and as of right now flirting with another bull tag here. And again, we avoided another bull tag by barely finishing above the moving average at the end of the day today. We had a bull tag for most of the day, for most of the month, all the way into most of today, or at least half of the day today, before that last rally. Intermediate lines falling, near-term lines also falling. But, set up for a bullish near-term low if we can bounce off of here and what would be seasonally a bullish month in April. All right, Russell 2000. That's not the most bullish chart. Obviously, we have the bull tag from over here. We're nowhere near clearing that, right? Nowhere near it. We've had multiple, the intermediate lines falling in the lower half of the chart. We're 10% below right now. The near-term line coming down from a bearish peak. That doesn't look good at all for the Russell 2000. So again, kind of hard still to really feel confident about the broader markets rally to the upside when the Russell just isn't joining the party. And we've seen this, divergence between the Russell and the S&P and other instances, most notably the end of the year from this November on. You can see right here, the last 3 months, that November with that long upper shadow into December and January. That's what the Russell 2000 looked like. The S&P 500, you can see, went up in November and December, and then had that candle there in January. So much different scenario in the S&P than what you saw in the Russell. And now you see it, that played out to a weaker market, and we're seeing that divergence show up here. So that's the market forecast on the different time frames. Let's take a look at the weekly chart here. And again, we had a reversal. So this is the reversal. We got a green arrow. We've had multiple reversals here. One, you can see we did not close above the high. So you can see that the close here was at 40.38, even though we're trading on actuality. The end of the week was 40.09, because this is that's where 41.09 is. But you can see the close of the Hakinyashi candle is 40.38, which is below this high point of 40.39. That's unique because, again, all these other reversal candles, you can see we easily cleared the high on that reversal. Over here, we easily cleared these highs. On this reversal here, we easily cleared that high point. On this reversal, we easily cleared that high point. Here, again, if it wasn't for a late push at the end of the day, where we went kind of parabolic at the end of the day today, we barely even touched that high point. We were well below it, again, to the very end of the day today. And this is a average of the open, high, low, and close for the entire week. So that's how strong the move was at the end of the day to get us even closer to it. But all these other reversals easily cleared that. And again, and I've shown you this chart before, all the other candles, the only candle that was about this size was this weak sauce move we had over here in January on the S&P 500. All the others were much bigger on these rallies. I mean, look over to my cursor to the right at the current candle, much smaller than this reversal candle. Look over here, much smaller than this reversal candle. And look over here again, much smaller than this reversal candle. So this is a pretty weak sauce reversal candle for a move that's trying to be higher. And you can see that too on the daily chart, the daily Hakinyashis. If you follow my cursor to the left, you can see the size of the candles, especially as we, again, this move here, the beginning of the year, very similar. I mean, this was actually a little bit bigger, tiny bit bigger. But a lot of these other candles, much bigger. If you follow my cursor to the right and look at where we're at today, much bigger there, much bigger here. Even on that failed attempt, much bigger. Over here you can see much bigger candle, and here too, and then over here in May, and then of course going into March, much bigger candles than what we see on this candle. So it's, as great of a move as we had, especially at the end of the day, it's a very weak, for the beginning of a bullish trend, it's very weak in terms of the size of this move. Looking at the Hakinyashis, right? The Hakinyashis they're able to give us kind of an average, like a really good look at the, again, the open, high, low, and close, the average of all those, giving us the close, and the size of that body is what gives us, this differential here, and the 3-day average is what you see in purple. But the green line is just today's candle size. So not a very big candle compared to what we're seeing on these other rallies, the other beginnings. These weren't necessarily like bull market beginnings either. These were just like bear market rallies that started off much stronger than what we're even getting now. And again, this last one is the only one that even compares to the size of that candle. And let's look at the 3 green arrows. So we do have 3 green arrows now across the board. Finally, 3 days in a row for the S&P. The Nasdaq's been there. 2 days in a row for 2 days in a row for the Dow, and then Russell still doesn't have 3 green arrows, but we're pretty close. But you can see we got the beginnings of a trending move right now, and that's really good. Again, like the market forecast chart, when you got those signs I told you, you get the bear tag and you follow through. This and how bullish that is. This is the same thing. You get the 3 green arrows and hold it and extend and turn the line green is about as good as you can get. That's about as good of a pattern as you can get there, especially when you combine it with the bullish market forecast pattern. Looking at the 2-line version of this chart, you can see we're getting back up to those pre-February highs. Not quite there yet, and that's where the narrative changing levels are. 78% retracement of this decline, the 50% retracement. So that's, and as well as the value area for this past year. So that's the important level we really need to clear from the Fibonacci level. So we're not quite there yet. The Qs, on the other hand, have cleared a very important Fibonacci level. This is extremely important. Not only is it the 78% that we're trying to clear, the 50% of the correction is still a little bit higher. It's up at the August peak. We are above the February peak. But we also have cleared that 38% retracement, which we have been trying to do, and looks like we might have cleared it there, as well as these other 2 red dotted line from the post-2009 low point rally, and then the 38% retracement of the post-COVID rally. So this is a confluence of multiple time frames of very significant Fibonacci levels, and it looks like we just busted through it. Again, one day doesn't make a breakout. You have to hold it. But if we hold it, you can see just how significant that is. Potentially in getting everything else to come up with it. IWM, the problem is we were nowhere near that third, this would be that same level. Relatively close to that same level is right here. And you can see we are nowhere near that. So that's the problem with the Russell. It's barely above the 17-day moving average. It's actually still below its 200-day. And for that matter, it's also still below its 200-week moving average. So the Russell is still telling us that we're not nearly as bullish as we think we are. And we're coming, we're not really breaking multiple moving averages. But, on the other hand, the Qs are telling us we're about as bullish as you could possibly be, because we're above all these moving averages, and they're all rising pretty sharply here. Let's take a look at the S&P 500 on the DMI. Give it a second to load up here. All right, so you notice you have a good bullish pattern here. You're above 30 on the positive indicator. You're not quite below 20 yet, but obviously you're getting there. The Qs have been bullish for most of this quarter. We're making another run easily above 30, well below 15. But really stands out to me is whenever I break, like the short-term move that it's had. If I break this DMI in half, you can see that this is, see, it didn't take it. Let's do it again. Oh, that's why, because it was. Here, let's bring up DMI again. I think I did the wrong one. And then now let's break, not that one in half, this one in half. There we go. So we'll break that one in half, and you can see we're well above 40 on the positive and below 15 on the negative, and working our way down on the spiders. If you look at the Qs, we're back below 10, or right on 10, and well above 45 on the positive indicator, with the ADX well above 40 again for the second time this quarter. Very, very parabolic move in the short term. Again, compared to IWM, which, again, this is a short-term DMI. We're barely above 25, and the ADX is barely coming off a really extremely bearish move. And the same thing with the diamonds as well. You can see the diamonds a little bit more bullish than the Russell, but same idea. Like this quarter, we had a big, strong bearish move, whereas, again, the Qs had two really strong bullish moves. Really parabolic, much stronger than the bearishness that we saw on those other indexes. So really taking off there. If you take a look at some of the other oscillators, like the Ichimoku Cloud, we still don't have a bullish trend going. I mean, it's a nice breakout, and you got a positive rate of change. Everything's good from that perspective. But we don't even have a weak trend going. The NASDAQ not only has has a weak trend going, doesn't have anything more than that though. It just has a weak trend. As bullish as this move is, it's been so short term and so parabolic that it can't get a trend developed here. But I mean, your 26-day rate of change is way positive, like really, really strong move to the upside. IWM, very extremely negative rate of change over 26 days, and you actually still have an intermediate trend strength bearishness. So like we haven't ended the bearish trend despite the rally we've been on. So you see the disparity still. You still can't quite get over that. We did hit 100, so we did hit the 4-week high. We're only off of it by 0.5 percentile because we didn't close at the high. We closed like a point off the high. So that's why we're in the 99.5 percentile. But still, we got to 100. So we did get a change there. That's really good. The Bollinger Bands, we didn't quite get up above the 100% mark, but we got to 97. That's good, right? And the bandwidth is widening. It's about to get outside of the Keltner channels with rising momentum. Very, very good sign from that perspective. The Qs, remember, they did break above 100 early, when it started its rally. And then, of course, got outside the Keltner channels. We are outside the Keltner channel now. So this is the kind of move we're hoping that the S&P does. Of course, that's IWM. On the other side of the spectrum, or the Qs, the other side of the spectrum, IWM has a declining bandwidth that had expanded because of a decline. The bands are still outside the Keltner channels because of a weakness, not because of strength. And we're barely in the upper half of the chart. So you see the disparities there. It's kind of hard to be strongly bullish when we're not getting the confirmation. The McClellan oscillator is showing some pretty significant breadth. Remember, we have been below minus 100. if we get a good strong Monday, we might get above positive 100. If we get above positive 100, you have a breadth thrust now. And there's some other breadth thrust indicators that are on the cusp that could get there on Monday too. So Monday, we could really like push up to the upside, confirm this parabolic move, and get going, and we can get that thrust to the upside there. The money flow also is crossed above the midpoint of the chart. We're still kind of lacking. If you look at, when was the last time we've been, let's see, when we, even if you go way back here, but let's say the last time was like right over here, a little bit higher. You can see on that day, it was the last time we've been here on a rally to the upside. We got to 410.80 and we're at 409 now. So pretty close. And you can see, again, we're not, let's see, we'd be actually right here. We're not to that volume level. So we're still lagging behind in the upward moves in the volume. We're lagging behind that. You can see that in the spiders. You can also see it here in the diamonds. We're just not able to get the bullishness to really get going, though we are in the upper half of the chart there on the money flow index. IWM also is crossing about 50. So there is some positive developments there. I also was looking at the new high, new low, the new highs and new lows here. As you can see, the skew is still below its moving average. Oh, it's popped up. But if you look at the new high and new low index, here's that other thrust indicator. That's at 60, right? You have to get above 61.5, which is right here. So you have to get above that level to get the breadth. You have to go from below 40 in 10 days to get above 61.5, and we're at 0.6 on this breadth thrust indicator. So we're close, and then you can see the new highs and new lows, again, are still not positive. It's like, come on, like, how bullish do you have to be? Like, we are, again, we're not getting the support from these other areas that would suggest just how bullish we are. We didn't look at the RSI. Did we? The RSI and the CCI. We are above 60, and we are well above 150. So you could argue now that if this holds, which you expect it will, then we are now out of. See, this one, you barely got a 150 there. You had a little bit of a fake out move that looked like this was a bullish part of it. Didn't quite get up above, especially didn't get above that 200 level. Just barely got above the 150. Well, we're pretty darn close. You could argue that this is a good breakout here on the S&P. The Nasdaq, of course, it's way bullish. The Russell 2000, not so much. We're barely crossing above 50. We're barely above 150 down there, but at least we're above 150. So there are some signs that things are moving in the right direction. Another really good sign here is the Arun indicator. We got a new 4-week high point, so we really busted through. Now, granted, we did it with a common gap. Now, can that be a runaway gap? Sure. It's not likely that either one of these are runaway gaps, because again, so in class today we looked at all of the other bear tags on the market forecast chart where you get above that falling moving average and the intermediate line crosses above 50 on the market forecast. So again, for this to kind of reiterate, this bear tag. So that bear tag comes from the intermediate line rising above 50, and which makes it light green shading, and we cross above the moving average, which is still falling at the same time. That's what that bear tag tells us. So on all the other bear tags, either on the day or the day next to it, or the day before it, excuse me, we had 2% rallies. Every bullish move. Remember I told you about those weak sauce Hakunashi candles? Well, here's another weak sauce. Every other bullish trend started with a 2% rally. All these runaway gaps, like we saw, potentially a couple days ago down here, always ends with a 2% gain. And these intermediate rallies start with 2% gains, usually on the day of the bear tag, if not before, the day or two before. In fact, back in March, I believe it was March, we didn't get it on the day of the bear tag. We got it these 2 days before, the 15th and the 16th. The bear tag occurred on the 17th, but the 2 days before that, going into the moving average, we had 2% rallies. So every intermediate run started with a 2% rally. Not this one. So far, not this one. Not even really on the NASDAQ. Now, remember, the NASDAQ's intermediate rally started earlier. So you actually did, if you look at when the bear tag, let's see, let's go to the market forecast chart here, and let's go to the NASDAQ 100. Its bear tag never did get a bear tag, actually. So it'd be this bull tag that we started, but it really over here is when probably would have been the bear tag on 316. If you look at right here, there's 316. So the Qs actually did start its intermediate run with a 2% move, but not the S&P 500. So another just red flag. It's like what every other move did. Even this weak sauce move we had in December or the beginning of the year, it started with a 2% rally right there. So, and that was a very weak move that ended up with that exhaustion gap in February 2nd, and it was the weakest rally that we've had of this past year. Even that one started one. And if this one doesn't, again, that just goes to show just how weak this move possibly could be. So, but at least you got a new 4-week low. And the other thing too that's standing out is your the volume and the ranges. So your volume was 112 million. The range was 5 points. You have to add in a little bit of a gap there, 4037 to 404. So about an eighth, almost a full point. So you're looking at pretty much 6 points. So just a little bit below the average on the range, a little bit above the average here. But if you look at the charts down here, again, you can see you have to break the 1.5% mark to really get a trend going, and we're almost there. And the volume at 112 million, the volume's still pretty high. It's kind of interesting to see the volume be at a pretty decent high point, relatively speaking, right? Relatively speaking, the last couple of years, it's a pretty high level of volume. If you look at the VIX during those same time frames, the VIX is actually all of those coincided with a pretty decent run in the VIX. This would be the lowest peak of the VIX, higher than that December low point we came off of when it was just in the low 20s, and it was just very temporary. But this is we've dropped to 18.7. We've dropped below 19 again. The last few times we dropped below 19, the VVIX didn't come down that fast, but this time it did. In fact, during our class today, the VVIX was near its lows. It really rallied at the end of the day. When the VVIX was near its lows, this was the biggest drop in the VVIX that we had seen in years, in a matter of however many days this was, and because we looked at a weekly chart. So this 2-week decline when we were at the lows is one of the bigger percentage declines we've seen in a long time. You can see the VIX too. That's a pretty decent 2-week decline there. We've seen other 2-week declines, but not from 25. Like to get from 20, we did open up higher, but that's a pretty decent move to the downside over the matter of 2 weeks, and you can see a very strong correlation after being pretty negative for getting down below zero on the weekly chart, which is obviously very rare, as you can see. And typically again these low points lead to jumps to the upside and volatility. This one actually was a jump to the upside, where the VIX rally without the VVIX. So, but considering that the bottom was formed with a decline, you'd expect to move to the upside on the VIX. And again, considering how fast we've declined over such a short amount of time, again, I expect, in the past, like that's typically a sign that the VIX has a good opportunity to rally. You can see how fast it's dropped down in the matter of however many days, 2 weeks. The histogram has already bottomed out here. The MACD is getting to low levels we've seen before, and like I said, we're already below 20. This is a really low level, and here's a good opportunity. Every other time we get down below 19, below 20, the VIX rally is pretty good. Like you can see, over here it jumped up, right there it jumped up, right there it jumped up, right here it jumped up. Even if they're little short-term moves, they jump up pretty quickly, and you can see some of these other instances getting below 20. The VIX jumps up pretty quick. So we're going to know really quickly next week if things change in terms of sentiment. If all these red flags produce a jump in volatility, and the end of quarter, a new beginning of a new quarter, especially with the jobs numbers coming out by the end of the week, starts to impact, and people not necessarily like fade the rally, but take profits off of what has been, an insanely, like I tweeted this out Let me bring this over so you can see it. This is the heat map for the last quarter that TrendSpider put out there, and I quoted, I quote tweeted this so you could see it. This is the heat map. Again, the S&P 500 was up 7%, and this is your heat map. That's a pretty good quarter. That's a really, really good quarter. And this is the heat map. I mean, you can see the big name. This is, the boxes are by market cap, so obviously they stand out. Microsoft and Apple and Google and Meta and Amazon. But look at these numbers. 70%, 22.5%, 75%, 17%, Netflix 18%, Nvidia 90%, Microsoft 20%, Apple 27%, Applied Materials down here 27%. You can kind of see some of these areas. FedEx had a good quarter, but you can also see some other areas that weren't nearly as good. Safe consumer staples, energy, industrials names, healthcare names. Obviously, financial names had a bad quarter. I mean, these are all really, unless you're a Visa MasterCard, which barely made the shift. Recently made the shift from technology into financials. But you can kind of see this is not necessarily a nice, good, solid quarter, right? It's very concentrated, very, very concentrated, especially into the XLK area and a little bit into the XLC area, which is a smaller sector, but it's got some pretty big names inside of it that also had some really, really good returns over this quarter. So again, is that the kind of like it wouldn't necessarily be like, oh, let's short these stocks. But if you start running out of buyers or people start just taking profits on these, you can kind of see why parabolic moves can correct themselves. Here's the parabolic move on the Qs relative to IWM and just how bullish that move has been. Let me zoom in so you can see that over the last couple of years. Again, from that February peak that we talked about in our last video, February 2nd peak of 2022, the Qs have really underperformed. But you can see as long as it took back here to get to that peak, it took, so many months. It took only like 10 days to get from here to 1.8. So a really, really strong move. You can see the strong spike in the MACD and the all these other oscillators of the relative strength. What's going to happen when this starts to correct itself, which again is very possible considering the end of the quarter, going into a new month, going into a new earnings season, a new earnings cycle here. All right, now let's take a look at what's driving a lot of this price action. Let's take a look at the different asset classes out there. You can see bonds had a really good rally here today. Interesting to see stocks and bonds moving up over the last few days, kind of renewing that relationship where they both go up at the same time. The intermediate line's falling. It's above 50. It's falling, so it's got a light pink shading, but pretty darn close to dark green if it turns back up. And everything else dark green, like Bitcoin's up, dark green shading in the green line. This is the global basket of equities up with dark green shading and a yellow line. There's your international equities down here. EFA, EEM lagging behind where we see EFA silver is doing really well. Copper, not really confirming this move to the upside. Crude oil, starting to move. I don't know if we really want that to move up though. Crude oil there, and you can see the 10-year yield moving back down, which has been a good proponent, a good propellant of this market up to the upside. You can see gold holding its gains with the dollar holding its downward trend that we're in here. Let's just take a look at how things have performed here this week. So let's jump back out. You can see the 3-month. I mean, look at this 3-month chart. This is quarter to date. So this is starting on the beginning of the year here. This is the quarter to date. I believe it's 1 through. Let's see if it is. Yeah, it is the first day of the year. So 20.5% gain for the Qs. This is crazy. Commodities not doing so well, but again, that's okay. The bonds are higher, matching the S&P's returns incidentally to the upside. Remember, they both dropped to the downside. In fact, TLT way underperformed SPY to the downside in 2022. Big rebound this quarter, and then of course you can see Let's just take a look at just this week alone and see this parabolic week, especially this close that we had to the week. And you can see, boom, look at real estate was up 5%. That kind of got lost in the shuffle. Developed markets actually outpacing the Qs. The S&P 500, IWM had actually a better week than the Qs did with all the chatter that the Qs have been getting. IWM, which has been very lagging, has had a much better return. And then, of course, you can see what's going on down here with the safe haven asset classes, bonds, gold, the dollar, all lagging behind. Remember, I showed you this chart from this February the 3rd is when this peaked. February the 2nd is when it peaked. So if you go all the way back to that February the 3rd of when the NASDAQ was outpacing, had peaked against the Russell 2000, and then the Russell 2000 has been on a, and then it rebounded here at the beginning of this year. You can see now they are pretty close to matching their returns from that time frame. So the NASDAQ has really come back off of this. It was November the 4th right there. Or November the 3rd. There's the lowest point that the NASDAQ got to the Russell 2000. You can see that's when the dollar peaked up there. It started to move lower. That's when the commodities peaked and started to move lower. And that's when bond yields bottomed out and started to move, or bonds, bottomed out and started to move higher. All right, all those factors which had been so bearish for equities, reversing to the upside. You can see, though, the dollar actually still is bullish. The yields are still up, and commodities are still up too. In fact, have been rebounding. In fact, when you look at the commodity move, there's your S&P. Here's commodities, and that's a pretty good move that we haven't seen in a while in commodities. With the drop in the dollar, still below its moving averages, below the 50-day moving average, and still below the 8 and the 17-day. I mentioned the performance on bonds. Bonds are set to break, potentially, right? Break to the upside. A significant break up to, say, 115 on TLT more than likely will not coincide with the S&P 500 or the NASDAQ continuing this bullishness. So that's something to keep in mind. Like that, this is a safe haven asset class, and over the past year they've been rallying, but we're not in an inflationary environment. We're starting to be less and less of an inflationary environment, more and more of a disinflationary, transitioning to a deflationary environment, in which case stocks and bonds move opposite each other, and you can see that correlation between the two. If you look at down there is the S&P 500, and here's the bonds. You can see the correlations have been getting more negative over the last little bit, and that's, we have been, especially if I were to zoom out to, like, say, a quarterly rotation here, and then change this. Let's change the graph. Something that's a little bit easier. Maybe I should just resave this. It's a little easier to see the graph here. So there's there is the positive correlation that we have had during this inflationary environment. But you can see we've been gradually getting less and less positive. And as I mentioned to you before, when you go back to the 10-day, which is just a 2-week correlation, we're getting more and more negative. Like, this is more negative than what we've seen since the end of 2021. And again, that was right before the market, the Russell 2000 started to decline. The S&P continued to rally, and TLT started to decline. And so that the relationship got more negative than it had been, and it started to falter. And we're seeing that again here. Very, very, starting to be more and more negative of a correlation, which is back to the normal situation that we've known for a long time. Again, if I were to zoom out here, let me zoom out to a longer time frame. Let's go to a weekly chart, and then let's go to a 13-week chart. So you can see the quarterly moves, and you can see traditionally over the week, quarterly, we're negatively correlated. You can see it spends a lot more time below zero until the beginning of 2021, and inflation skyrocketed, and stocks and bonds started to move together. In this case, both to the downside. As they started to move together here especially throughout most of 2022. But now you can see we've turned back positive, or we've turned back to being negative again after being positive. We've turned back to being negative again. And so that's, we might be in that transition. So when you look at that and you say, okay, the relationship's turning negative again, and TLT has had a good week along with equities, and is poised to really break out here. Like again, that's not going to be bullish. Like if the yield spread gets any more inverted, that's not bullish. Like as of right now, it's the 10-year to 3-month is dramatically inverted, like way more than historically it ever is. Here's the maximum over the course of time for this inversion. That's way lower than what we've seen in a very, very long time. 1982 was the last time. And of course, you can see the 10 and 2-year back to 58 basis points, and it's off of its lows. But even that, again, if the 10-year starts to drop with TLT rising, that's going to make that inverted curve even more inverted. And at some point in time is going to cause the Fed to start cutting rates. And again, the last thing we want, I know the bulls on TV talk about the macro case is for, and I want the market to be bullish, right? Everybody does, right? Because we're all mostly bullish in our long-term portfolios. And so the macro case is, hey, the Fed's going to start cutting rates. That's not the case. If we're going to get to 4,800 by the end of the year, which, I mean, if we don't, it would be, the probabilities are close to 100%, considering all the factors I've been tweeting about and collecting, all throughout the first quarter, whether it's the January effect or the Santa Claus rally or this, that, or that, or everything else has come out. I've been collecting it. I quote tweet them and let you know, like, there's a lot of factors here based off this first quarter performance that suggests that we pretty much are going to be, if not above it, pretty darn close to 4,800 by the end of the year. Really, really good return. I mean, high probability of that happening too. For that to happen, we have to have one more rate hike. The Fed has to feel like we're okay enough to get this 50-50 shot, and this was at 100, to get back to 100 and to actually get the rate hike. And then we can't have any rate cuts by the end of the year. A month ago, we were not planning on any rate cuts. We had a 93% chance that we would still be at 5.25% by the end of the year. No rate cuts. Now it's a 99% chance that we'll be below 5.25%. So things have changed dramatically. These numbers need to come back down here. That's the only way, that, in my opinion, because if we start cutting rates, as is widely expected to do, as soon as September, you can see because we're currently at 5%, there's a 60 some odd percent chance, and it was 90% chances a week ago that we're going to cut rates by September. These numbers has to keep going up and up and up and up. There can't be any rate cuts by the end of the year, and well into 2024 there can't be any rate cuts. The market has to be able to take this rate hikes, digest it, and still be able to rally and move forward. Still have the economic wherewithal and earnings to be able to push up to new highs without these rate hikes being an issue. That's what we need, because if the rate hikes do become an issue as big and as fast as they were, as you expect that they will, then it's going to cause the 10-year yield to drop, TLT to break out, 10-year yield to drop, the inverted yield curve to get that much bigger, and the Fed's got to start cutting rates, and that's not what we want, right? That they will not cut rates because, hey, that we should do this now because that's the cycle. We've been raising rates, and now we'll cut rates because everybody's happy now. We should cut rates. That's not how it works. They cut rates whenever they feel like they need to stoke demand. There obviously is plenty of demand out there for different assets. They don't need to stoke demand with rate cuts. If they do, and they've said this before, they will only cut rates if they have to, if they really have to. In other words, the 10-year note is tanking, and the 2 years dropping, and the 3 months still holding up, and these inverted yield curves are so dramatic. They just have to cut rates. And that's only going to happen if we are in a situation where people really want to buy bonds, long-term bonds, at such a small yield that much. And that's what's going to cause the breakout here on TLT. If we can hold resistance and bounce down, great. The problem is we've been converging. And when you've been converging over such a long period of time, you expect that we will eventually reverse, right? You reverse up so you can see this convergence. The long-term MACD has been turning positive here. You'd expect we're going to break above this 23% retracement and start working our way up towards that 115 level, which is the next layer of resistance. And that, again, it will only happen, more than likely will only happen because, again, why would anyone right now want to buy 10-year bonds at a 3.5% interest rate versus short-term treasuries, which are at 5%? Because they're worried, right? They're worried, and that's what pushes TLT up higher, and that's my expectation. I expect those gaps that I showed you earlier to fill, and I expect that coming out of the quarter we might not be so bullish. I think a lot of this had to do with end of the quarter, and momentum just carries on parabolic moves, but it was just so niche and such a small area of the market, even though the market cap is so big in that area, that the fact that we didn't get, that we had a 20% gain in the NASDAQ and a 0% gain and 0 point whatever percent gain in the Dow goes to show that this is probably not as broad of a rally that we really, really need to see as bullish as we are. Right? We should be a lot more bullish in a lot of these other indicators that I've shown you here before. All right, let's take a quick look at how the sectors are performing. Look at XLK, big time move, 22.5%, excuse me, over the past quarter, 16% for XLY, 19% for XLC, and that's where it stops, right? I mean, that's where it literally stops. XLE is down 2% over the last 3 months. XLB had a really strong move today to get to a 4% gain for the last 3 months. XLI had a really strong move this week to get to a 3% gain for last year. I mean, they're all light green shading in the 40s in the intermediate line and yellow lines. So all getting bear tags right now, like the S&P did a couple of days ago. And then XLF still down 6% over the last 3 months. XLV got a bear tag. It's down 4%. Staples, look at the run Staples had over the past week just to get to a flat 3-month return. That's how bearish it had been. XLU also rallying up to a 4% loss for the 3 months. And then you can see real estate with the bear tag there, light green shading, and the yellow line up 1%. So you see the dramatic shift here when you look at the comparison chart. Again, XLC, XLY, XLK, all significant gains to the upside. But again, go all the way back to that February 4th time frame. I believe it was February the 4th, was it? Back over here, it was, let's see, February the 3rd. So it was the second that we peaked there. So from that February 2nd time frame here, so let's go February the 2nd of 2022 all the way up to now. You can see why XLK. So November the 4th was November the 3rd. So that was the lowest point that the Qs got to IWM. You see how they had been significant losers relative to everybody else. Energy had been such a big winner, was actually peaking at that time. Healthcare was flat, utility staples all holding up pretty flat. From that point, you can see the safe haven areas are still pretty flat. Industrial is kind of joining them. XLK has rebounded and passed the SPX. XLC and XLY haven't. So as big of a return that they've had pretty much since that November 3rd, or was it the 4th? The 3rd. So from November the 4th on, that's when they hit that lowest point against the Russell 2000. From November the 4th on until now, I mean, look at that, 27% returns on those two. XLY had been a big loser early. Amazon, Tesla, is matching the market now at a 10% gain with materials, industrials there as well. Energy, financials, not surprising that financials would be down, but your safe haven areas down as well. So essentially what has been not working is actually what's working now. If I go to the 1 year, again, go back to the beginning of the year for 2022 into the end of the year for 2022. So just the calendar year returns. The XLK down 28%, XLY 36%, XLC 38%, real estate down 30% as well, and all these other areas really holding up. XLE was up 57%. So is it surprising to see over the last 3 months that they rebounded the most? I mean, it shouldn't be that surprising at all. And they have. They've rebounded really big. The question is whether or not that's enough of a rebound to really change the trend, to get back up to 4,800, right? Is this just really a heavily oversold technical bounce You saw that here in this tweet. I wanted to bring this up too. Right here, let me bring this over. This tweet, and you can see it. XLK, XLY, XLC going into this year were very highly overbought. Remember, the Russell 2000 started to falter in November, post-Thanksgiving. These were highly overbought, the Qs were. All the way up to that February 2nd peak, which is about right there. It's that February 2nd peak. And then the Qs started to underperform. From that point, started to underperform the Russell 2000, as well as the equal weighted S&P, and really dropped. By the end of the year, they were down big time relative to where the equal weighted was, and then now has since just caught up. The question is whether this period is, would be considered, a continuation of this trend, and it's just a rebound off of a lower low point, or are we turning this around? Again, you can see what Mike Santoli is talking about. We're basically just flat 2 years, but the equal weighted S&P had rallied back up to being flat a few months ago, or late in last year had rallied up to being flat since that same equal time frame, and it took this long for the Qs, and really at the beginning of the year it took this long for the Qs essentially just to catch up to where the equal weight was, because it was so far down. And again, that's our bull case, right? Are we really this bullish simply because the NASDAQ was playing catch up from a heavily oversold condition relative to even its equal weighted counterpart of the same stock, essentially the same stocks, especially with the weightings there. All right, let's take a look at our trade idea for today. Let's take a look here at this chart on the market forecast first. John Deere, you can see very similar to a bear tag. In this case, you actually already got the green line. That's why it's not, you don't see that there. The intermediate line's rising above its market sentiment. You can see the near-term line well into the reversal zone. So you got a bullish pattern here, rising above the moving average. You can also see as well that we have DE. We have a green arrow. We have a transition candle. That transition candle happens to also be a very strong bullish candle. One of your biggest bullish candles that we've had here in a while. You can see we're above the 0.84 now. So pretty good opportunity. That's on the regular candle. Sorry, here's the Haki-Nashi candle. We'll see if we end up getting, you have a good chance of getting a pretty decent sized candle next week on there. If you look at the 3 green arrow chart for the year, you obviously have 3 green arrows and they're above the moving average, but we also crossed above the 50-day moving average at the same time. We're also close to crossing above 0 on the MACD. We'll do that on Monday, and the stochastics is almost above 60. So you have really good opportunities here on the stock that's starting to make a little bit of a run. Of course, your negative indicator, your positive's above 30, that's great, but your negative's too high, so it's not quite there yet. You look at the RSI and the CCI, and you think, okay, they're rallying, they're above their midpoints, but they're not really, high enough quite yet. Looking at their Bollinger Bands, we have a falling bandwidth, and we're not in the upper quartile yet. The momentum has been negative, and you can see the bands are starting to come inside the Keltner channels. So we don't have necessarily the greatest bullish chart yet for a directional move. We still have no trend here. We're below the cloud. We have a negative rate of change. So when I want to make a bullish trade, but I don't want to have something that needs a bullish move, then I just do the bull put spread. So I go to the mid-30s delta, sell the 405, buy the 402.5. This is what it ends up looking like. You need at least 58 cents on a $2.50 wide spread to get a 30% return on your risk. So we ended up getting, I believe, 70 cents. So just a little bit more than what we needed. Full position size, so you don't have to worry about earnings for April. And you can see we got a 420. As long as the stock stays, you can see how it kind of broke out today into an area of very little volume in the short term because we dropped so fast here. If it stays up there, then we can hold this, right? The break even is essentially getting back into the lower half of this chart and breaking back into this gap that we had today, this dead cat bounce. You see we had kind of a dead cat bounce there where we jumped up, pulled down, and then rallied. So obviously it's the opposite of a I guess you would call it an inverted dead cat bounce, since dead cat bounce technically are to the downside, but it's the same pattern just to the upside here. So as long as we hold that, great. If we come back into the gap, we probably don't want to be bullish anymore anyway, because that would be a significant reversal there, and that's when we'll end up getting out. And the most, we have $1,000 at risk, but again, on any kind of short premium trade like this, you want to keep your losses to no more than that $420 there. All right, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums that you can access for free on our website. Open up any new thread there with any questions or comments you have about the video today. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join our website at marketscholars.com, as I showed you earlier. Follow us on Twitter and on Facebook, LinkedIn, all the social platforms. Like our content there so you can make sure you keep getting it. Have a great rest of your weekend, everybody, and we'll see you all next time.